Wealth and Wisdom is brought to you by the Johannesburg Stock Exchange.
Hello and welcome to Wealth and Wisdom. With me tonight, I have Natale Labia of Nedbank Capital. He works in their debt capital markets team and does some corporate bond issuance. So tonight we're going to learn a little bit more about the bond market. Welcome to the show, Natale.
Thanks, James. Great to be here.
So Natale, how big is the bond market in South Africa?
Well, the listed bond market in South Africa is 1.4 trillion rand, which is compared to the equity market really quite a bit smaller. The equity space, there's about 6 trillion rand worth of listed equities, which makes it by far the biggest listed market in the country.
And then there's a bit that's not listed. There's quite a bit of that bond space is kind of not listed.
Well, absolutely. A lot of debt in South Africa is obviously bank funded, by far the majority of it. And then a lot of it is privately placed with investors. It tends to be a sign of the maturity of an economy. The more debt that is listed and publicly traded and visible, the more mature the economy really is.
So in South Africa, we've got an equity market. I think the total market cap is something around 6 trillion.
Yeah.
And then we've got 1.4 trillion of listed, maybe another 1.4 trillion of unlisted. So about 3 trillion to 6. So it's about 50%-ish.
Yeah.
Now, is there a lot of room for growth in this space?
No, tremendous room. If you look at developed economies such as the US, the debt market is about 80 to 90% of the equity market. So the more developed South Africa becomes, you'll see the more debt is issued. So there's definitely a lot of room for growth. One of the main trends that we're going to see is that with Basel III and with the cost of funding for banks going up, more and more corporates are going to start looking for debt in the listed space. And that will mean that the debt capital market in South Africa will grow exponentially in the next 10 years.
Okay, so Basel III, just run me through what's the 10-word summation of Basel III?
Basel III will change the way that banks operate. A whole bunch of regulations will change. Effectively, the summation of it is that the cost of funding for banks will go up. Therefore, the cost of funds for companies borrowing from banks will get higher. This means that it'll become more cost effective for companies to look for debt in the listed space.
Okay, so it's going to be possibly cheaper in the future to issue bonds than it is to get bank lending because of these new Basel III regulations. Basel is this town in Switzerland, it's the Bank of International Settlements, and it's quite interesting because we're starting to see stuff coming through the market. Like one of the things that, if you listen to the radio, you've probably heard these ads, Investec want your money, FNB want your money, Nedbank also looking for your money, ABSA looking for your money, all these sort of longer term funding things. A lot of that's being driven by Basel III.
Well, absolutely. I mean, there are various aspects to Basel, but crucially, regulations mean that banks will have to be a lot more careful with liquidity. And that means matching your assets to your liabilities, so that if there's a run on the bank, you've got short-term assets to match short-term liabilities.
Okay.
This means also that banks will have to be a lot more careful about their capital structure. Ultimately, the whole kind of lend long, fund short mentality will have to change.
I mean, that's what did for Northern Rock. They were lending home loans and they're borrowing 3-month money. There's a huge mismatch that they couldn't then keep rolling the 3-month funding.
Absolutely.
And they weren't getting in the money on the 20-year side, so it suddenly became quite a nasty situation.
Absolutely.
But that is it's a fundamental change in the South African banking market, and the effects are going to be quite big.
It will be profound. I think the way the banks operate and are profitable will change a lot over the next 10 years, which is great for our business. It means that the debt capital space will become more and more relevant.
So if I'm a small corporate, what is the benefit to me of doing bond funding rather than trying to get a bank loan?
It's basically cheaper.
Okay.
That's the kind of at the heart of the matter is the fact that it's cheaper for a corporate, by and large, to seek funds from an asset manager, an investor, through the listed market rather than purely from a bank. If you look at how banks make money, they have liquidity and reserves, basically the cost of funds. On top of that, there's a spread, and then the spread is what they earn. An asset manager doesn't have the liquidity and reserves.
Okay.
So you're always going to manage, you will by and large be able to get funds, let's say 50 to 100 basis points cheaper in the listed space than from a bank.
So it's a 4% cheaper in terms
however,
of
one must be very, very careful because listed debt should not be seen as a substitute for bank funding.
Okay.
They need to be complements. There is space on every company's balance sheet for some listed debt and then bank-funded debt. Banks offer facilities and flexibilities and support.
So if things are really going badly, you could push out the terms
Absolutely.
of your loan or something. You could do some sort of minor restructuring with the bank.
So the last thing that a company should do is look to replace its bank funding and its bank relationships, which is crucial, with debt capital market instruments.
That's really, really interesting. We're going to take a short break, and after the break, we're going to be back and learning a little bit more about the South African bond market, where it is at the moment, and where we see it heading in the next 10, 20 years.
JSE Safex style options, a great choice.